Tesla gets upgraded by analysts. But are they out of their minds? What in the world are they trying to tell us? Is it actually a good thing for your Tesla stock? I'll answer those questions for you right now. Welcome back, everyone. In this video, we will break down the upgrades from the Goldman Sachs Analyst, Credit Suisse Analyst, and the Jeffries Analyst. And if you like making money and want hard-hitting analysis, okay, maybe not hard-hitting, but better than the expert analysis we're getting ready to discuss, go ahead and subscribe, hit that little notifications bell, and while you're down there, go ahead and hit the like button as well. So we're going to go over the breakdown of all the analyst calls on Tesla as they stand today. And as you can see, some positive trends have started here in April just as the US went into lockdown. And that's one of the first things that I don't like about analyst calls. They are notoriously slow and sometimes just behind altogether. But don't worry, as you will see, it gets much more ridiculous as we dive into the actual details. But let's start off light first, from what I feel is the call that at least makes the most sense and had some solid fundamentals behind it. Even if you don't agree with the call or the price, at least it's a coherent case being made. The first analyst upgrade we'll look at is Goldman Sachs. Goldman Sachs has a stellar reputation on Wall Street. Main Street, not so much. But they were ahead of the curve in 2007 and typically have been the envy of others on Wall Street. Not here to debate the merits of how they actually make their money, but just to say they don't typically need to make outlandish predictions to get their name in the news. They are Goldman, and in their world, not much else needs to be said. They have been a notorious bear of Tesla from the start, cutting price targets multiple times last year before finally dropping coverage of Tesla altogether. Now they are back in the game at rating Tesla, and they gave them a fresh buy rating to boot. Let's see what they said. We're gonna give this reading in public thing one more chance here. And I'm quoting Goldman analyst Mark Delaney. He said, "We are positive on Tesla because we believe that the company has a significant product lead in EVs, which is a market where we expect long-term secular growth." I think most of this channel has been saying that for quite some time now. He also points to the combination of Tesla's product leadership and early mover advantage. Goldman also sees the Model Y helping Tesla to have more traction in the important SUV and crossover market. And finally, Goldman assigns a price target of $864 on Tesla stock. See, a nice, well thought out rating with a commensurate price target that matches. Even if you don't agree, at least I understand their position. Curious note here though, let's look into the details a touch more. The announcement was made after hours and shares were up about 5% or so in that after hours trading window. But that was after it ran up over 9% for the day during the regular session. And there was really no news during the day to cause that run up. I wonder if a big player was tipped off that this rating was coming. Nope, never on Wall Street, nope. The next upgrade we'll look at is Credit Suisse. Here is where my disdain starts to come out just a little bit. Although you may not have agreed with Goldman, at least they have the stock as a buy, made points supporting their position, and gave it a price target that made sense given their analysis. So now on to Credit Suisse. Credit Suisse upgraded out of bearish territory to neutral from Underperform. They also moved their target price up to $580 from $415. And shares of Tesla at the time of this upgrade were right around $700. So that makes sense since he only sees Tesla as neutral for now. Dan Levy, who is the analyst at Credit Suisse covering Tesla, points out that Tesla has a larger competitive advantage in the transition to EVs, especially as the illness will make it more difficult for legacy automakers to make the long-term shift to EV. Wait, this guy got paid more money than most of us to give that analysis? First, the illness had nothing to do with putting legacy automakers behind. They were already way behind. The illness is just accelerating the continued erosion of their balance sheets. Tesla was running away each year in regards to EV tech. The illness will just be a convenient excuse for those guys. But it keeps going. Hang on, it keeps going. Levy sees Tesla as having a clear advantage in batteries. So what he's saying is Tesla's batteries are better. They also have improved liquidity, meaning they raise more cash and have lower debt loads, so they are, more liquid. And signs of improvements in execution. Basically, their factories are getting more and more efficient and able to put out more capacity. Thanks for giving me information that my 12-year-old son could tell me. And I don't even have a 12-year-old son. Did this guy just Google the top 5 latest news items for Tesla and just copy and pasted it? Seriously, but if you want analysis that is better than a 12-year-old can give, well, maybe only marginally better, make sure you are subscribed so you can get the truth on all this craziness. And show your support for the channel by liking the video. Hey, at least I'm not as dumb as that guy. Jeez. And we'll take a look at the final analyst from Jeffries. Jeffries Analyst Felipe. I'm not even gonna bother trying to pronounce his last name. I went to public school, I'm sorry, I have no clue. I'll just put it up on the screen there for you guys. He upgraded Tesla stock from a hold up to a buy. The analyst still sees 2020 revenue growth at 27%. He sees the company's earnings and free cash flow will be supported by better productivity, a stable average selling prices, and income from zero-emission vehicle credits. He also says Tesla is the only legacy-free car maker, and they are participating in a positive EV sum game. Really? He goes on. Post-illness, he expects higher consumer support for energy-efficient transport. However, the analyst decreased his target price on the stock from $800 to $650. But wait, he downgraded from a buy to a hold just 2 months ago with a target price of $800. Now he upgrades it to a buy and downgrades the price to $650. What is this guy doing? And furthermore, how does he have a job? If only I had a job where I could tell you to buy something now as an investment, because it's a great investment, it will make you lots of money. But in the future, I think it'll be worth less than what you paid for it today. Who in their right mind would buy based on that? And that is exactly what this guy just said. I'm done. I hate analysts. It's ridiculous. Seriously, I try to make predictions and give you guys information as best as I can with the information I have. And I admit it, I'm not right a lot of the time. But if I said something like, buy Tesla now at $700 because I think it will be worth $100 in a year, you guys would destroy me down in the comments section. This is just crazy. So the next thing you need to do is click this video right here to get more details on my strategy for buying Tesla stock that makes more sense than these guys. Thanks.